Welcome to Flippening, the first and original podcast for full-time, professional, and institutional crypto investors. I'm your host, Clay Collins. Each week, we discuss the cryptocurrency economy, new investment strategies for maximizing returns, and stories from the front lines of financial disruption. Go to flippening.com to join our newsletter for cryptocurrency investors and find out just why this podcast is called Flippening.
Clay Collins is the CEO of Nomics. All opinions expressed by Clay and podcast guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions.
Welcome to this two-part case study on fund tokenization and issuing a token for your equity. As far as I know, this is the first published end-to-end case study and deep dive on fund tokenization and what it actually takes to tokenize your company and equity in your entity or project. This case study is an addendum to our security tokenization documentary entitled Tokenize the World, which you can find at securitytokendocumentary.com. At the time of this recording, it's been 8 months since we first published the documentary. Since then, hundreds of thousands of people have downloaded it, and the humbling and unexpected success of this 3-part series entitled Tokenize the World is part of what put the Flippening podcast on the map. If you haven't heard it, just Google the phrase Tokenize the World, and our documentary will be the first one that pops up. As a refresher, the Tokenize the World documentary was broken into 3 episodes. Part 1 of the documentary was an introduction to securities, tokenization, and security tokenization. In part 2 of the documentary, we covered security token platforms and discussed how issuance actually works. And in part 3, we squinted our eyes and stared into the future to see what it might hold. Today's episode is a continuation of the content just mentioned and an end-to-end case study of what security tokenization and issuance actually looks like when we move past concepts and into actual implementation and execution. Indeed, there are a lot of thought leaders and people grandstanding on Twitter and experts that can speak to individual components of the tokenization process. But the truth is that very few of these thought leaders have issued a functional security token that they're actually using and that is actually being traded. So here's some real talk. I often hear people who have never actually issued a security token advising companies to tokenize. In fact, on well over 10 occasions, people who should know better, but who have never actually done this process have just casually thrown out that Nomics, which is the company that I work for and that runs and funds this podcast, but they've suggested that Nomics should tokenize our equity in our company as if it's a simple process. And nothing could be further from the truth. In this case study, our guest, Rob Nance from CityBlock Capital, is brutally honest and shares that although he's happy with how things turned out in the end, and he's happy about the experience he gained, if he had known from the outset how difficult the journey would have been to tokenize his fund, he would have never started. So today's episode is the first installment of a 2-part case study featuring CityBlock Capital and Rob Nance from CityBlock. Full disclosure, CityBlock Capital is an investor in Nomics, along with CoVenture Crypto, who deployed the capital. But we would have had him on the podcast anyway, because there just aren't a lot of case studies like this that exist, right? There's a lot of people talking the talk, not a lot of people walking the walk. Today, Rob is going to share with us an end-to-end case study on how he tokenized his fund. He's going to take us along this arduous journey. This case study is broken up into 3 chapters. In chapter 1, you'll learn what tokenized funds are, how they work, and the benefits they provide. In chapter 2, we discuss the 5 steps required to launch a tokenized fund. And finally, in chapter 3, Rob gives us his take on what the future looks like. We'll get into the content in just a second, but before we get started in that, I'd like to pause for a moment to tell you that this episode is brought to you by the generous support of Currency.com. Currency.com is making this episode possible, and without them, this content would not exist. My heartfelt thanks goes out to them. Here's a little bit about them. Currency.com is the world's first regulated tokenized securities exchange. that allows you to use Bitcoin or Ethereum holdings and even fiat to trade the world's biggest markets through tokenized securities. Choose to trade with up to 100x leverage or buy and sell assets of your choice from over 200 tokenized securities. Crypto traders are able to trade traditional financial assets without putting their holdings under price pressure or exchanging to fiat. Of course, this is all possible with the security, trust, and precision of blockchain technology. It's simple. Trade with crypto, profit in crypto. Sign up using our special link at currency.com/nomics. Again, that's currency.com/nomics. As a side note, I like these guys. We don't accept sponsors that we don't believe in. And I had a great conversation with currency.com's CEO, Ivan Gowan, and I was frankly just blown away by what they're doing. If you have wanted to use crypto to trade against untokenized markets like commodities or indices like the DAX, if you've wanted to use equities to have a position in companies like Amazon or Apple, then currency.com is the only regulated exchange that I know of where this can happen. And these folks are total pros. In fact, currency.com is run by capital.com, which is a pretty significant exchange that has billion-dollar plus trading volume days, not so infrequently. And this has my endorsement. If you want to check them out or you just want to show your support for the show, please go to currency.com/nomics to show them that sponsoring the Flippening podcast was a good use of their resources. This episode is also brought to you by the Nomics API. If you need an enterprise-grade crypto market data API for your fund, smart contract, or app, then consider trying out the Nomics API. Our API enables programmatic access to clean, normalized, and gapless primary source trade data across a number of cryptocurrency exchanges. Instead of having to integrate with multiple exchange APIs of varying quality, you can get everything through one screaming fast fire hose. If you found that you or your engineering team have to spend too much time cleaning up and maintaining data sets instead of identifying opportunities, or if you're tired of interpolated data and want raw primary source trades delivered simply and consistently with top-notch support and SLAs, then check us out at nomicsapi.com. All right. Let's get this started. Here, without further ado, is part 1 of this case study on security tokenization. Rob, can you tell us a little bit about yourself and the origin story behind CityBlock Capital?
Sure. So I have kind of a unique background, not a traditional venture background. I've worked in banking, ended up leaving with one of my clients to start a venture fund about 4 years ago. That fund's been very successful, and we got ready to raise our second venture fund. What do you do when you're raising your second venture fund? Well, the first thing you do is go back to your original LPs, your original investors, and ask them for more money. So I went back to one of my LPs and said, hey, raising a fund, I'd like more money. And he looked at me with a dead straight face and said, Rob, the average venture fund lasts twice as long as the average American marriage. And I like you, but I don't want to marry you twice. And so, I started laughing and I said, that's funny, but seriously. And he said, listen, it's a problem with this asset class as someone that's invested in it a lot. And it really got me thinking, which was, is there a better way to do this? Is there a better way to build a venture fund? I listened to a lot of really great podcasts and I listened to some of the investors on there. And I'm in awe of their ability to look at the universe in a very unique way. What is challenging about accessing those individuals is that they typically have established funds. They typically have LPs. The minimum investment size in one of their funds may be anywhere from $250,000 to several $1 million. With CityBlock, our aim was to provide access to those individuals to investors around the world, to be able to take investors that are in Japan or in Europe or anywhere in the world and connect them with these individuals and do it in a scalable way. One of the problems with the legacy venture system that exists is that because it is so paper-based, it's hard to scale. It's hard for them to accept a lot of investors. So we started thinking and said, what if we were able to create a scalable model? And as CityBlock, work with the best investors in the world. What if we went to them and said, we want to give you a dedicated pool of capital and have that pool to invest in an area that you're an absolute expert in, and have a a token that represents that's tracked by net asset value, that would allow investors for all over the world to access it, but you don't have to worry about working with them. You don't have to worry about raising money. You don't have to worry about going out there and managing the investors. We'll do all that. But we will use your expertise to give the world access to what you see that others don't.
Is it an oversimplification to call CityBlock Capital a tokenized fund of funds? Or is that not quite right?
I would say that it is a little bit of an oversimplification because we're not investing into existing funds. We're looking for managers that maybe they're on their third fund, maybe they're on their fourth fund. They don't necessarily have institutional capital pouring in yet. They have a great track record. They've worked at top tier firms, and they have a very unique insight to the world that no one else has. And it's something that's generally very sector specific. They're usually not generalists. And what we'd love to do is partner with them and give them the capital to use to deploy into this area, but do it in a more public manner. So when I think of fund of funds, I think of, well, here's the money, you go out and deploy it, and we report back to the LPs. This is more of an interactive experience. This is more of a forward-facing experience where we really want to engage with these individuals. We want to engage with the communities which invest with them and provide that bridge.
When CityBlock Capital backs an investor, they're not allocating capital behind an existing fund. They're partnering with a specific manager as an individual who provides influence on investments that are made out of the CityBlock Capital Fund. Is that correct? It's your relationship is primarily with individuals who are making these decisions, not with companies or institutions.
Correct. So it's with individuals that may work at firms. They may not have a dedicated pool of capital for this specific area that they want to invest. So the example I use is our current partners with Nikhil and Atit at CoVenture. So they're at the firm CoVenture. They're at CoVenture Crypto. They run a liquid strategies crypto trading fund. And what's interesting is that because they run this liquid strategies fund, all of these entrepreneurs that are out there today that are building this infrastructure in the blockchain space for crypto and digital assets come to them and say, hey, can you test my product? Can you help me make this better? And they see all these startups and they say, hey, do you want to invest? And they didn't have a dedicated pool of capital. So we partner with them because we have a dedicated pool of venture capital. They have this really unique proprietary deal flow that allows them to see that space that we then, deploy venture opportunities that they see through their actively traded business.
You spoke about scalability. It seems like one of the ways which you outlined that this is scalable is that it's international in nature. So is it true that you can accept, investors from almost any part of the world, and you can back managers that are in any part of the world? Are both of those things correct? Or is it more complicated than that?
It's true to a certain extent. There certainly are legal requirements that we have to follow in each country in which we have an investor, where they come from. So Japan has different rules than, England does. And so we have to follow the rules in each country in which we sell a security. And so it is one of the difficult things about what we do is working with attorneys in every country in with which we sell. So yes, it can be done. Is it a little bit burdensome? Sure, to begin with, but once we understand a country and have legal counsel there, it makes it easier to sell in the future. I think one thing you pointed out is really important is that we can also work with managers anywhere in the world. Managers that may have a very unique investment thesis in a market that we don't understand. And they have that unique view because they're there locally. And we can globally take capital and deploy that locally into this expert manager.
Thinking a little bit about the token and the role that plays, maybe taking liquidity off the table. Is this kind of thing possible without a token? What of this could you do versus not do without a token?
You can do everything without a token that you can do with a token. I know that's kind of a shocking answer. It's just very inefficient. Think of it like, could you operate in business today without email? Absolutely. You could send letters. It's just going to take a lot longer, and you're going to have a staff to maintain all of it. So what we're trying to do is, just like email brought efficiencies to communication, this is bringing efficiencies to securities. And because we're bringing this efficiency, it helps managers, ourselves, accept more investors at lower minimums. And it also allows us to work with investors from all over the globe.
I've never heard of this model before. I don't have as much exposure as you do to financial products and the world of Wall Street, although I have a fair bit of exposure there. What was the inspiration for this model? Like, I've seen quite a few fund of funds. This sounds like it's different. Is there a predecessor to CityBlock Capital, either started by you or someone else? Like, what was the inspiration for deploying capital in this way?
So I think the inspiration behind what we were doing was kind of a combination of what we've seen before attempted in the venture market with someone like AngelList, and what this kind of ICO craze of 2017 did, which was illegally, but allowed investors to access a lot of different opportunities. And we thought, it'd be really interesting is if we had a legally compliant way for all these investors to access great opportunities. And I don't just mean token, but equity of early stage companies. Would that really be appealing? Couple that with, there are so many amazing managers out there that have a very small pool of capital they manage. And that's because they hate fundraising. Maybe they're bad at fundraising. And if we can put capital in their hands and connect them with investors, that's good for the manager. It's good for the investors. It allows us to take this really elite asset class and provide it to more people around the globe.
So Rob, given the novelty of how you guys operate and that there isn't a ton of precedent, I think most of our listeners would love to learn a little bit more about capital deployment. Certainly I would. Do you leave these decisions 100% in the hands of the managers? Do they generally consult you? What are the decisions that you make? What are the decisions that you leave them to make? And what decisions are kind of jointly made?
The manager's job is to source amazing deals and partially negotiate them, bring them to us. We do the legal work around the deal. Let's look at the deal. Let's see if it needs to be structured differently. And then we kind of jointly make a decision whether it's a good investment or not. I defer to the expertise of these great investors. They're great and they have great track records because they're really good at what they do. Our job is to work with them, certainly. But the most important thing is to provide that support of, okay, now we have this term sheet, it needs to be marked up, or we need a term sheet. And that's why we have in-house legal counsel that can work with them to get that done.
How do you think about liquidity and the burden that creates around the fund? To have a fund that's constantly priced, where there does need to be some price discovery. Most VC funds are 10 to 12 year time horizon and lockup. And yes, there's some kind of reporting to investors, but I think the burden around that reporting is a lesser standard because it's not used to inform weekly or monthly decisions about buying or selling a token. What kind of information do you provide, in terms of disclosures to token holders?
So this was a big struggle for us. There's two sides to this equation. One is on the investor side, providing as much information as they can have access to. On the other side, we're investing in private companies. And private companies want to stay private, and they don't want their information all out over the internet or what's happening. So we had to figure out how to strike a balance there, a balance between providing updated information on portfolio companies and also not allowing that information to go public. So what we do is we report the net asset value of the portfolio quarterly, and that's reflected based on the underlying investments, but we don't disclose the positions we hold in the underlying investments because we don't want someone backing into what companies are working, what companies aren't working well, because they're privately held companies. So at the end of the day, investors quarterly will receive, here's net asset value of the portfolio, and that can help them make decisions. We release, at the founder's approval, information about the company, about progress it's made, if they want to share that publicly. But we certainly are very cautious to maintain the privacy of our portfolio companies.
When it comes to net asset value, not having ever run a VC fund, is there some kind of standard methodology for doing that, or are there accounting firms that specialize in assessing the value of privately held companies? How does that work?
This is a good question, but a hard one to answer. At the end of the day, how do you value a privately held venture-backed company? Well, certainly there's people that use options-based models. There's people that value it at the last round of funding. The answer is there are no really good ways to measure these companies that are especially at the early stage. We take a conservative approach and value them at the last round of funding. We also use an accounting firm that specializes in it. If there hasn't been a round of funding for 18 months, it may not make sense to value it at the last round, and maybe there needs to be an independent valuation expert that comes in and works with that. Unfortunately, it's the nature of the game that it's very hard to value. That's part of investing in venture, is that you can't do a discounted cash flow on a pre-revenue business. So, there are no tried and true methods to necessarily value it. Now, certainly for some businesses, SaaS-based businesses, we have metrics that we've used and we know, but there isn't always a day-to-day value like there would be with a publicly traded security.
Given what you said just now, regardless of the size of your position, you would need information rights in all the companies that you invest in. Is that correct? Like for the purpose of valuating the fund?
Yeah, absolutely. We always request information rights from companies, but we're also very clear with them that we don't make their information public through this vehicle.
You are doing something incredibly hard. It's hard enough to start a VC fund and to raise capital for the asset class, which historically hasn't done really well, and where the majority of returns come from, a handful of, or at least the top 10%, the top 5% of VC funds. You need to start a VC fund. You need to raise money. You need to explore how liquidity affects what you're doing. You've got this model with managers, and then you're tokenizing. Is there anything that I've missed in sort of like the list of things that you're doing that's hard or new?
I certainly made a decision not to make my life easy for about an 18-month period. This has been a challenge, an order of magnitude harder than everything I've ever done. And when you phrase it that way, it does seem a little crazy.
What is it about you that compelled you to do so many new things? Like, do you have this love of financial products? Like, are you a product person? Is it the confluence of your interest in cryptocurrencies and tokenization and new ways to do VC? There's a part of what you're doing that's rational and has the potential to generate huge returns. And there's a part of what you're doing that's, because it's so early, it's like, maybe no rational person would do this unless they just genuinely love creating financial products and, being a trailblazer. Like, what is it about you that led you to do this?
Running my last venture fund, I enjoyed investing, but I didn't love it. And what I learned is that I really love fundraising. People are like, you like fun? No one likes fundraising. I love fundraising. And so I thought, what's a model I can build where I create a business where my job is just to fundraise, and I can have an amazing time fundraising because I'm doing it for the smartest people in the world. And I'm working with them more than not, here, take some money and go invest it, but really partnering with them to tell their story to the world. And so I was able to create, we were able to create this model at CityBloc where we went out and we've partnered NYCQ, our first fund, and we hope to do that many, many more times over. But able to partner with these people, and sure, we could have done this without tokenization, but that's just one level that makes it better. And it's so early. It is so early in this space that not many people really understand it yet. I think that's where the opportunity to earn outsized returns and build great businesses is before most people realize it.
Thinking about blockchain capital and what they did with their BCAP token, versus what you're doing, it sounds like there's some precedent and there were some things to learn from others who have been down this road. There's a lot of what you're doing here that's also net new. If someone said to you, like, what's the difference between, what you did and what blockchain capital did at a very high level, like kind of prior to really digging into this case study, how would you describe that difference?
I don't want to speak specifically to someone else's offering and what they did. Certainly, like the other trailblazers in this space, they had a lot of challenges that went through. And the thing I learned from them were that they had a lot of headwinds, both on a technology front and on a legal front. And so what I took away from what they did was we have to be very, very purposeful in finding the best legal counsel and the best technology provider that can help us actually create this.
To kick off the first chapter of this case study, The first place to start is just, what is a tokenized fund?
Tokenized fund is just a venture fund that is built using blockchain technology. So there's nothing special beyond that. Our LP interests, instead of being shares, are denominated in tokens. And that allows us to utilize this blockchain technology as an underlying mechanism for transfer. So we've chosen to build our fund using Ethereum as the underlying protocol that it runs on. But it could be any protocol. It could be anything that comes in the future that's better that we could move it over to. The only difference that exists between us and a traditional or a legacy venture fund is that we're built for secondary market trading. We are built for efficiencies in managing LPs beyond kind of this paper structure that's existed.
How does someone go about investing in a tokenized fund? Is they like go to your website and then there's like an address and they send it through, or is there AML KYC? Like, what if I were a potential LP and was considering, investing in your fund and, wanted a primer on kind of like the end-to-end user experience around just actually making that investment? What does that look like? Do I have to be in the United States? Is there AML KYC? Like, what would I actually do to put money into your fund?
To put money in the fund, there's a couple steps. As you alluded, one of those is KYC AML. Let's make sure that we know who you are and that you pass all the security checks that exist. The second would be filling out a private placement memorandum, subscription agreement, and limited partnership agreement. That is a key element of the fund, just like it would be for a regular fund. So where does someone go to do that? Well, they can go to our website, and then they're directed to a secure portal it's backed by a couple different people. One of those is Securitize, who's our technology provider. They're the ones that actually build the technology that allows LP interests to be traded. The other is a broker-dealer we work with, US Capital Partners. And the third place that someone can really go to purchase this would be SharesPost, who's another one of our partners. And for example, when you go to SharesPost, you go through and you select, yes, I'm an accredited investor. I want to purchase X amount of this security, which is denominated in dollars. And then there's a flow that individuals go through that prove they're an accredited investor. They have to prove, who they are with their documents. And then they can go through and fill out, as I mentioned, the private placement memorandum, the LPA, the subscription agreement. And then that is sent to compliance for review. And if that's passed, then they're accepted into the fund.
Once they're accepted into the fund, is it portal and securitize.io? Like, where do they actually see, here's the address to send your Ethereum to? How does that happen?
To be clear, we accept US dollar for investment, so people can send us US dollar. Okay. They set up their own wallet, which they can do in a number of places. They can do it on the Securitize portal. And then we send our tokens, our digital representations, to that wallet. And so there's a couple different options of what they do. They certainly can take that themselves and put it on a Trezor or another wallet that they have. Or in the case of SharesPost will custody it for them.
So they can just write you a check like a traditional investment, and then you'll send them tokens somehow through Securitize.
Right. And what's important to remember about these tokens is that they're not bearer instruments. So if you think of Bitcoin, right? Bitcoin is a bearer instrument. And I use this example, and this may date me and may some people on the podcast. But if you haven't seen the movie Die Hard, go watch it and then come back to this part of the podcast. Because if you remember in the original Die Hard movie, the terrorists break into Nakatomi Plaza. And they break in to steal these bearer bonds. Why? Because if they bear the bonds, they're theirs, right? That is the value. They don't break in and try to steal stock certificates of the Nakatomi Corporation. Why? Because the next day, the Nakatomi Corporation would just cancel those and reissue new ones. It's very, very similar to how it works in the security token world or the digital asset world. If someone were to have those tokens and lose them, we have a record, a centralized ledger, GASP, of who owns what, because they've signed these documents. And we'll then go and just reissue them new digital securities.
Hey, I wanted to cut in here for a second to let you know that this Tokenize the World case study is brought to you by Currency.com. Currency.com has amassed a great team, and I recently had a chance to speak with their CEO, Ivan Gowan, and I'm blown away, frankly, by what they've built. If you've wanted to use crypto to trade against untokenized markets like commodities, indices like the DAX and equities like Amazon or Apple, then currency.com is the only regulated exchange that I know of where this can happen. And they're MiFID II compliant for those of you who live in Europe. These folks are total pros. In fact, currency.com is run by capital.com, which is a pretty significant exchange that does a ton of volume and is involved in a lot of things and making a lot of things happen. If you want to check them out, or you just want to show your support for this show, then please go to currency.com/Nomics to show them that sponsoring Nomics was a good use of their resources. Again, go to currency.com/Nomics. This case study is also brought to you by the Nomics API. The Nomics Market Data API offers squeaky clean and normalized primary source trade data offered through fast and modern endpoints. If you're a professional investor or developer, you need accurate prices, and I can tell you that our competitors' prices are often not accurate. We're actually going to come out with a report about this soon. I should note that the Nomics API is used by many of the largest and most influential companies in the space, including top exchanges that you've probably heard of, 100 million plus AUM funds and prop shops. Hit us up if you'd like more details or go to nomicsapi.com. Back to the show.
Now, that's not ideal, but what's important to remember is we've solved this big issue, which is if you have Bitcoin and you lose it, it's lost forever. The person that has it, it's theirs. That's not the case with this. So while this is not a trustless system like you would think of with Bitcoin, it is a much better system, a much better way to transact, creates more fluidity as we're moving these securities.
That makes sense. And I think people want that safety. I always use this example of like Trump Tower. Let's say the Russian mafia ends up with the majority of the Trump Tower coin, right? Could they just show up one day and occupy Trump Tower? Like that's a bad idea. And it's also a bad idea, for companies. It's some unknown entity owns, the majority of the stock in your company because they did some hack. Like that's stupid. No one thinks that should happen. This isn't trying to be Bitcoin. It doesn't need ultimate decentralization. But in terms of the token itself, is it just like any other ERC20 token? You can have it on your, MetaMask wallet, or you can have it, on like my crypto, or it's just like another ERC20 token.
Absolutely. So what Securitize does and what they do with their technology is they're able to basically restrict the trading of that. So you can't move that from the wallet before you meet certain criteria, which is one of the really cool parts of security tokens. Is that we can find a way to restrict this trading and to do it at the actual token or the smart contract layer. And this is important for a lot of reasons.
So the fund itself is denominated in USD. It sounds like you'll accept investments in a number of different cryptocurrencies, or at least BTC and Ethereum. Is that right though? But the denomination is in USD?
Correct. So we initially accepted US dollar, Bitcoin, and Ethereum. At kind of the beginning, we're only accepting US dollar now for investment, but it certainly is possible if you have a tokenized fund to accept a number of cryptocurrencies as investment. And then generally people will hold that in escrow until they have a closing and convert it to US dollar.
Let's say someone, receives their token. What's the symbol for your security token?
NYCQ.
NYCQ. Okay. So someone receives their NYCQ, they're in their wallet. Maybe some time has passed. There's a lockup that they've gotten past, and they are ready to trade the token. They like what their returns look like. They've made what they wanted to. Maybe they want to sell 20% or some of their position. How does that work right now? Or are you still waiting for the infrastructure to develop that would allow this?
So what's interesting is the majority of the infrastructure does not exist today for secondary market trading. And it's why I tell investors in our fund, if you don't expect to hold this 3 years, don't buy it. Don't buy this and expect you're going to flip it tomorrow like it was some ICO that was going up 10,000% a week. This is a real security. And if the fund achieves a return that you're really happy with in 3-4 years and you need liquidity, that is built in. Now, there's no guarantee of that liquidity. There are a lot of people working on it. We've seen T0 working on it. We've partnered specifically with SharesPost. And we partner with them because they've been experts in secondary market trading of securities for many, many years. And they have a large number of investors that want to buy secondary shares of companies like Uber, companies like Airbnb. And so it's a natural fit for someone like us that is investing in these high quality deals in a variety of spaces to give investors access and they have this infrastructure that exists today to trade it. So I think this infrastructure will be built out over the next 2 to 3 years. Certainly, it's at a much more limited scale today than I think most people think or realize.
Let's kick off chapter 2. I think that there's been a lot of talk in this space that's theoretical, that speaks to maybe, the characteristics of security tokens, that speaks to maybe the pros and cons. But there hasn't been a really good case study, in my opinion, and end-to-end walkthrough of someone, going about doing this. And so we defined a few steps along the way. Step 1, as we talked about, was, building the product, the thesis and the pitch. Step 2 is finding legal counsel that thinks they can do this. Step 3 is finding a technology provider, hopefully someone who can work with the legal counsel. Step 4 is building the offer. And step 5 is tokenizing. So part 1 of this journey that one might go on, and that you certainly went on, to creating a tokenized fund, is building the product, the thesis, the pitch, and the team. So if someone were attempting to initiate all of this, like they decided they wanted to do some version of what you've done, how would you advise them to get started, and what would you forewarn them about?
So the first thing I would say is that doing a security token offering is not a magic bullet to raise money. If you could not raise money from traditional sources for the quote unquote traditional version of this, then you're not going to do it this way. There's not gobs of internet money out there that exists for this. And so, when we started this process, that was kind of our thesis was, there's all this internet money that's going to come in. And it's just not true. It just doesn't exist. There was a lot of people speculating on an ICO bubble. Those people have since disappeared. What does exist, if you have an extremely high quality asset, is investors, thoughtful, accredited investors from all over the world who want to participate. And you can access those individuals easier through this offering, but it doesn't mean it's going to be any easier to raise money than it would be if you were traditionally.
It's not a panacea. It's not like you tokenize and all of a sudden, there's this wall of capital just dying to get into what you're doing. What other initial upfront guidance would you give? Like, I know when you started this, the world was very, the space moves very quickly. The world was very different than it is now. What do you think has changed between, when you first got started and now? Do you think the barriers to entry are lower? What has changed during this time?
I think you see a lot of people now saying they're going to tokenize. I have meetings with people all day long. They're like, we're going to tokenize these 30 assets and we're going to do X, Y, Z. And certainly this process is so much easier than when we started. People know what a security token is. When we started, that term didn't even exist. No one had any idea what we were talking about. The question I would get most is like, well, how many nodes are you running? I was like, what are you talking about? I don't understand. I don't even understand what language you're talking to me in, as someone that comes from a traditional capital markets background. And so certainly today, everyone that was a quote unquote ICO advisor is now also an STO advisor. And I think that's funny because they haven't done an offering. They have no experience in this. There's so few people that have actually gone from beginning to end.
So what about building the process, the thesis, and the pitch? So we don't have to cover how to create a pitch. It's if you're going to raise a fund, you need to know how to pitch. That's probably a different universe of context and of content and beyond the scope of this content. If you're an investor, you need a thesis. Hopefully it's unique. Hopefully people want to put money behind it. But, maybe the kind of the part to focus on here is, building the team and building the product. What's different about, building the team and the product and perhaps the thesis and the pitch, when you're talking about a tokenized fund versus a non-tokenized fund?
When I think of this process, the big difference is that technology is going to be a large part of your offering. So certainly legal is a large part of any traditional offering in the fund space. You have great fund attorneys that work in there, but having a technology provider that can work with attorneys. And I don't know if you've ever tried to get technologists and lawyers in the same room. It's a very expensive, many, many meetings with lawyers just saying, no, you can't do that. And technology is proving that they can create the restrictions that the lawyers want around it. On top of that is building a product, as you talked about. It's kind of triangle that on top would sit the product. And it obviously has to be a good product to sell through that. And in the middle of that kind of triangle is the team. And a team has to have a different skill set than traditional funds. So the team has to, I really think, have a technologist on it, someone that can bridge the gap between the capital markets people and the actual technologists themselves, someone that understands distribution, someone that understands the internet. And I think you have to have an in-house lawyer, someone that can fend off the lawyers and help them understand what we're doing and why it's important, and be that go-to between the fund manager and the external legal team.
Perhaps one of the core things to cover in this chapter is like, what's the cost of entry? Like, what does it actually take to do this? As you mentioned, a lot of people say they're going to tokenize and they don't know what that means. So what are the upfront costs? Like you mentioned in-house legal counsel. Is that like full-time on the payroll, salaried with benefits legal counsel? When it comes to technologists, like, would you advise again to not just have a consultant that maybe can work 5 to 10, 20 hours a week, or is it substantially more than that in both the legal and technology departments? And what do you think is needed in terms of commitment, both in terms of like duration from start to finish around this project, but also in terms of weekly and monthly commitments around hours?
I'll start by saying that this process has gotten much, much easier since we started. When we started, there were barely any attorneys that understood this space. We paid them a lot of money to learn a lot. So today, it's a lot easier if you go, and you may not need that. If you're not trying to build a scalable model like we are, and you want to tokenize a single asset or a single fund, there may not be the need for in-house counsel. I think that it depends on how you want to distribute things. I was talking the other day with someone that runs a Series D funded company. It's doing very, very well. And he is going to tokenize his Series E round. And he's going to tokenize it, and his existing LPs are going to get it. He's not using it for fundraising. He just thinks it's a better ownership mechanism that's very forward thinking. Now, certainly something like that is not as difficult as we're going to create a fund and distribute it to people around the world. So it's important to consider your scope. If you say, we want to create a fund where we can sell in 34 countries, whatever number around the world, that's going to require in-house counsel. It's going to require somebody that can work with counsel in every jurisdiction in which you sell an asset, which gets very, very expensive. If you don't want to do that, if you just want to sell in 1 or 2 jurisdictions, then maybe not. So there is someone that has to kind of be the quarterback. On the technology front, there's someone that has to, I really believe, quarterback that too. If I'm running a regular fund as Rob, I'm going out, I'm raising capital, I'm getting subscription agreements in, my lawyers are looking at them, and that's kind of the end of it. Someone doesn't have to check to make sure someone set up a wallet correctly. We don't have to necessarily go through the accredited investor requirements that a 506C, a public-facing offering, requires versus a 506B, which is a non-solicited offering, a private placement, where they just basically have to check a box and self-certify they're accredited. So there's all these extra steps that go into this larger public offering. And so it does really require building this team, this technologist that is working full-time, managing the inbound investors, making sure all the wallets are getting set up correctly, working with the external technology providers, and the lawyer that's there. And certainly we worked with John Avador of Startup.law, and he worked almost full-time for 4 months on our offering as we built this out. He dedicated an extreme amount of time to get this done because he was working with our multiple counsels. I can get in later to what's involved in working with that, but it's extremely time consuming.
Like when I look at companies like Securitized.io, Harbor, it looks on the surface like you can just go to them and that like they just do it for you. Like they handle everything, they handle the technology. They're just kind of like this safe, warm blanket around this process. What do you think is realistic for people who want to launch funds to expect from a Securitized.io or a Harbor? What is reasonable to expect? And what do you think is like sort of the best case scenario that one could hope for?
Sure. So I think what's important to remember is when we started, Harbor did not exist. Securitized did not exist. When we started, we had figured the legal portion out of our offering. And the next step for us was step 2, how do we figure out the technology? And we had searched high and low to find someone that could do this. And we had reached out to different groups. I think at the time, the group that had done BCAPs had broken up. They were no longer an entity. And so we literally could not find someone to work with. And one day we saw something online that said, hey, Spice VC is launching, and we're spinning out a company called Securitize that helps people do this. And I furiously, for 3 days, submitted for 4 times a day their information request, and there was no response. And so they made the mistake. I jokingly say of listing their founders on there. And so I went to Google and went to work. And about 10 pages into Google, one of the founders of Securitize is very involved at the PTA at his kid's school, and his phone number was on there. So I started calling it nonstop until he answered. He answered and said, "Who is this? And why do you keep calling me?" I said, "Give me 5 minutes and let me just talk to you." And 45 minutes later, he said, "Wow, that's amazing. Like, you understand the space, you understand what's going on." I said, I want to meet, really want to work with you. What you guys are saying makes a lot of sense to me. And he said, "Well, we're in San Francisco. We'll be in New York in a couple of weeks. Maybe we can meet then." And this was a Wednesday. I said, "What are you doing Friday?" He's like, "Well, we're in the office Friday morning." And I hopped on a plane Thursday and flew out and met with him and signed our contract on Friday. So this space, it just didn't exist. Now today, Securitize has a team of business development specialists that you can call and can work through and construct the offering with you and help you move down that path. When we were there was no one. There was like 2 founders and that was it. And so their technology has progressed to the point now that it is much more of a full service than it was when we started, as all startups are, right? When it's the very beginning, it's bare bones, but it's the technology that works. And today they're integrated with dozens of other vendors. But I still think your team does require somebody that can manage this process, and they can manage that. And you wouldn't have that process to manage if it was a traditional fund.
So that concludes part 1 of this Tokenize the World case study. We'll see you next week when we return with part 2. Special thanks to our guests and everyone else who has helped make this series possible, including Rob Nance of CityBlock Capital and our title sponsor, Currency.com, who made this content possible. Take care. That's it for this week. To sign up for our free crypto investing newsletter, listen to other episodes, or get the show notes from this episode, please visit flippening.com. I also invite you to check out the startup that funds this podcast, Nomics, spelled Nomics, at nomics.com. Finally, if you got value from the show, the biggest thing you can do to help us out is to leave a 5-star review with some comments and feedback on iTunes, Stitcher, or wherever you listen to podcasts. Thanks for listening, and see you next week.